Thought we would just go ahead and get started a little bit early. I'm just getting the Zoom set up. I like using the Zoom. It has those tools, including giving my mouse that little red laser dot. I know it's the little things in life. All right, so it's Monday. I've seen a few trade ideas this morning from the community. Everything looks good, right? Everything out there that we look at just seems ready to go. And so, it's something to think about. Try to have a reason. You know what I mean? Like we can bring up the Dow 30 for an example. That's usually my go-to. When I was new to trading, it was the very first watch list that I ever used. Thinkorswim has that pre-built. So we go down to, the Dow Jones. It's 30 companies. They're usually like household names most people would know: Apple, American Express, Boeing, Caterpillar. You start flipping through this list and you're going to realize that, everything in that shock and awe move from Friday is flipped over, right? So everything looks good. And a lot of things are going to be correlating right into the indexes themselves. We used to say SPY is Apple and Apple is SPY. And we kind of came up with that little phrase because new traders would come in and inevitably Apple or AMD would be one of the first things they would ask about. What do you think Apple's going to do? What do you think Apple's going to hold here, go up here, go down here? And the typical response is, well, what do you think SPY is going to do? Because that's what Apple's going to do. Now, things are a little more complicated than that in the current situation, but not by much. There's also a beta measurement that you can use, kind of asking a question, whatever market it is that you're looking at, and then tying that into something and saying, well, if the S&P moves 1% today, how far should this market move in correlation? Fast beta, there's a slow beta, or just beta. You can also get into like beta weighing your portfolio. That way you can look at the trades that you're holding and kind of gauge your risk. If you're, for an example, holding a lot of American Express and you want to know, well, how much pain am I going to suffer if American Express was to fall, or if SPY was to fall, 5%, something like that. Some platforms make it kind of easy to beta weigh. Thinkorswim is a little goofy in how you have to go in to get it set up. So you first have to do a little bit of housekeeping. Notice when I swapped over to beta weigh, all these trades popped up down here. I'm not in all of these. These are just things that I have built and stuck into the Analyze tab at some point. If you've never cleaned that out, then Thinkorswim is trying to remember all of those trades that you've looked at but didn't take. And it can really build up. This is often one of the reasons that your Thinkorswim gets slow, is because of all these trades. that you analyzed but didn't look at. So once you clean up all that junk, you have to tell it what you want to benchmark against. This would be your chance to put in something like the QQQ if you're holding a lot of trades that are like technology based. The default benchmark is the S&P. Most people just use SPY. Nothing wrong with that. And of course, we're not looking at a trade that I actually had over here. But this would be the start of how you would get to beta weighing a portfolio. Set your beta symbol, clean out all that trash. Hide any simulated trades. I mean, that's another way you can go. That should have done it. That should have brought up my... But yeah, Thinkorswim makes it a little goofy. On Tastyworks, if you log into the website version of the platform, not the desktop version, it has your beta weight already built and presented in a risk graph for you, which is really nice. You know, resetting it didn't do it either. I'm sure I'm missing something very obvious and simple. Who knows? Thinkorswim does not make it easy, that's for sure. So when you're trying to look at some trade ideas today, just kind of keep in mind that you have a lot of choices to choose from. And some of these choices have already moved a significant distance, right? So, you know, if your choice is to trade something that is, you know, up 0.25% versus something that is up 3% in the pre-market, I would rather trade something that, you know, isn't already up 3 or 4%. Be a better way to go. Technology really got hammered on Friday. That would be something worth looking into. I also talked about AUY over the weekend. It's not necessarily AUY as much as it is the sector or the industry, right? So I ran a scan for a strategy called the X-ray. It uses a monthly chart with a 1-period moving average and a 10-period moving average. And you're looking for a 110 cross when price is on the lower side of a Keltner channel. This is a longer duration trade setup, something that you would run, you know, for a couple of quarters, maybe even through most of the year. You want to target things that are like in the money options, or, you know, depending on your market, you may have to try to trade something a little bit cheaper, you know, go out of the money just because of costs. But you want to try to get in the money as much as possible for a couple of reasons. One, if you're in the money and you're holding on to an option that has, you know, 9 months or a year of life on it, if that market stalls for a while, you could sell options against it. And your choice of options to sell would be any of them, right? Any of them from where you're at to farther out of the money. If you already went far out of the money and then you try to sell options, you're limited. Right now, in something like AUY, that's not such a big deal. This is a very cheap market. So what I'm going to be looking for here in the gold market, not just AUY, but in this sector, is a long-term play to the upside. I'm probably going to look to pyramid into the position. I want to accumulate some stock underneath $6. And to do that, I'm looking to sell puts. So we're going to sell puts, $4 puts, maybe $4.50 or $5 puts. And, if the market stays underneath those, then I'm going to end up getting assigned. But if we rally out of those, then I'll just keep the credit. I don't want to sell puts beyond $6. And if you're kind of new to options, we can translate what that means when I say selling puts. If we put it in plain English, it means I want to buy your stock at this put price. So if I sell a $5 put, I'm putting out a statement that says I want to buy your stock at $5. If we rally higher than $5, I don't buy the stock. But if we stay underneath $5 at expiration, I would have to buy that stock at $5 a share. I kind of want the stock, but on the other hand, if I can just get away with selling puts and never get the stock, it won't really hurt my feelings. This is something that you can do in a smaller account, because it's a $4 product. So $100 or 100 shares at $4 a share, you need a buying power that can handle $400 plus some, right? Because you need to still be able to use the account for other things. When we went into the close last week, these $4 puts and $4.50 puts were running, less than $100. And I get it. It's not a lot of money. But if you're running an account where you're trying to trade directionally and you're losing frequently, maybe because you're picking the wrong direction, or price just doesn't move as far as you thought it would, or it didn't move where you thought it would fast enough, and you find that you're losing frequently, this is a way to trade without really picking a direction. Yes, we do need the stock to go up, but we got 136 days for it to do that. If you were to pick a different market, for an example, Twitter, since somebody just gave a shout out on Twitter, Twitter is a $52 product, so you're going to need a bigger account or maybe a margin account. You could go in and sell a put in Twitter at, say, the 35 strike for $100, and as long as Twitter stays above $35, you get that credit, and you didn't need the market to move. Now, what usually really freaks me out is I will see someone with $100,000 account, or a $200,000, $300,000, $400,000 account, and they're telling me that they can't make $1,000 a week. Like, how can you not make $1,000 a week when you've got a $300,000 or $400,000 account? And they tell me, well, I'm trying to find momentum. I'm trying to find trend. I'm trying to find direction. I'm late to the game. I'm getting in late. My entries aren't good. I'm getting out. I'm getting losses. Why? Why even try to trade that way unless you've got the skill set? You've got the years of experience to be able to do that. While you're growing that skill set, working on paper, learning how to trade momentum and trend and direction, while you're learning, you could still be making money from non-directional trades. Options are the best product in the world when it comes to making money in a market that didn't move. It's the best of all worlds. It doesn't matter if the market runs to the moon or not. Just drawing a simple line in the sand and saying, I bet you won't close below that line. That's a heck of a lot easier to trade. Which is usually why, we talk about duration and skill set. And the farther out in time you go, when we talk about the classification of ways to trade, investing, of course, is the easiest way to consistently make money with the least amount of risk. You got investing, and then you've got long-term swings, and then short-term swings, and then day trades. And each of these can all be broke down into their own categories, but investing is, I hate the word easy in trading, but it's the easiest, most consistent way to profit. Unfortunately, investing is a slow growth concept. It's why people, focus on like their retirement accounts and things like that. Because you've got, 40 years to work on your retirement account, slow growth, consistent growth, and it doesn't require a lot of your time. Long-term swings grow a little bit faster, are still really consistent, but it's still not fast enough growth if you're in a small account. And so that really leaves us in things like short-term swings and day trades. So when you're in a small account, your number one goal is to grow the account bigger. That way, that bigger account can generate more capital, and you can actually start using that capital for things other than growth. But try to focus on trade styles and trade setups that don't require you to be right all the time in a directional play. Twitter, just explosive move. I thought I had Trade Flash on there, but I guess not. I must have took it off. I don't know what the CEO did. I mean, I understand he's stepping down, but why is he stepping down, and why did the market like it so much? I don't know. If anybody knows what's up with that, then I would feel a lot better about making a trade decision for a swing trade. For a day trade, no problem. This is pure momentum. We just hop on and ride the bull. But for a swing trade, I would want to know the why. Why is the market so excited about the CEO stepping down? Sorry, I had to get the Zoom chat. I keep forgetting to leave that in a place where I can catch it. All right, so the AUI or the AUY that I was talking about, that's a very small company, and it's a great way to learn how to kind of get into premium trading without really getting hurt if you screw it up. We used to use AMC before AMC blew up and became an expensive product. We were selling puts in AMC, at the $2 and $3 strike earlier in the year. You want to just kind of dabble in it a little bit at a time until, it all starts to make sense. I mean, you can do it in paper, and it's recommended to do it in paper. I just find that I have commitment issues. Trying to take swing trades on paper, I can't seem to stay committed to the cause. It is what it is. If you can swing trade on paper, that's a really good thing to do. I just, I forget that I have the trade on, and I don't go to paper for months, and then when I do finally get over there, it's like, oh shoot, I forgot all about this trade that I had on. So it doesn't do any good. Right now on my futures account, I day trade on the futures in paper frequently, testing out pyramid entries or fading out, but it's not a swing trade, so it's easier to stay committed. All right, we got 15 seconds until the market opens. I want to come over to the Market Watch tab. We have it set to weeklies at the moment, but we're going to go into the Index Watch itself and bring up the S&P 100. And now you can see Merrick is really getting hammered to the downside. But look at that correlation. Everything out there, almost everything out there, is green. We've got 86% of the S&P 100 moving to the upside. 86% of the S&P is bullish this morning. And look at the money flowing. There's more money flowing into the S&P than out of the S&P, right? So it's not just an advanced decline line. It's a very detailed advanced decline line. All right, so we've got 100 to 1 almost on the money flow. Let's flip over and look at the Nasdaq. So here's the Nasdaq 100. 80% of the Nasdaq 100 is moving to the upside. The money flow is 200 to 1. One of the biggest movers in the list is Moderna. mRNA is up more than 11% this morning and still going. It did pull back off of those highs a little bit, but it's still going. A couple of names that are weak is Peloton, Trip, Zoom. So the names from Friday, like we were talking about earlier, not a surprise, right? The names that did good Friday are now not doing too hot. So the watch list that I have up right here is the S&P 100. We want to see how many of those names have broke out of their 15-minute open range. Of course, we don't have a 15-minute yet, right? Because we just got started. But this is a 15-minute OR breakout. This is a 15-minute squeeze and a 15-minute trend quality. So while we're waiting on the squeeze and the ORB, we'll bring up the trend. Exxon Mobil has a very strong trend gauge at the moment. You can see here the cloud that we're looking at is a 510 cloud on the daily chart. Exxon Mobil took a rejection off of the 10. The 5 is underneath the 10, which is why we've got a red cloud. And we're looking for price to get back up to around that 63.5 area. That would be my reciprocation play on that. That would also get us back above that 510 cloud. That one has the strongest trend quality out of all the names in the S&P 100 list at the moment. IBM, Chevron, so a lot of energy names. Nike, Qualcomm, Starbucks is doing good. Now we got that crossover in Nike. where the 5 crossed the 10, and then it flipped back over because of that price action on Friday. But that 510 is right over top of us. We got to get through that. The FANG names are doing really good. You can see at the top here, we got Facebook, Apple, Microsoft, Nvidia, and Tesla, all with trend and or trend and momentum. Just kind of letting things shake out a little bit. Let's see what's still in a squeeze. Exxon is still in a squeeze and getting ready to break that first candle. Oh, what's that? Back up. Allstate. Dividend day. Hard move to the downside. It's going to be coming out of that squeeze momentarily. BIIB. DHR. Nice flag continuation play there. Qualcomm. So Qualcomm made it above the 510 split. It's got an average daily range target of around 187. If I was trading options in Qualcomm today, that's the strikes that I would use. Just be careful because it's already up 3%. You know, that 181 is the line in the sand. If we get above 181, I would be looking for that to provide support. But at the moment, that's a rejection zone. It doesn't look like it's making its way through there yet. Let's go take a look at the S&P. It is a 0 day today, by the way. So we got a red candle. That's not unusual. When we gap up in the pre-market, a lot of times the indexes will attempt to close that gap first before they do anything else. Now, it's a little bit tricky because if we gap up in the pre-market and then we get bearish at the open, the fall isn't just to close the gap. It's actually just the fall, and you just fall through the day. So while everybody's trying to catch that falling knife and run the reversal to the upside, the market just keeps falling and falling and falling. And it turns out that it wasn't just a gap close. It was a market that turned to bearish. And we don't have that yet, but that's what we want to be focused on, you know, kind of asking that question. Are we just moving down in an attempt to close the gap, or are we moving down because the market has suddenly turned bearish? Now you can see the dollar is bid to the upside. The bonds are fading off. The Dow broke range. The Russell broke range. But the Russell's already back in the box, right? What box? Well, the box from Globex, I thought. Now when we try that on the Dow, that's not the Dow, that's the oil. I swapped that market out the other day and didn't put it back. There we go. So the Dow is back in the box. The Russell's in the box. The S&P and the Nasdaq, they are all back in the box, which is fine. I guess we're highly correlated, and we've seen that when we were looking at the advanced decline line. No big deal, right? But a correlated market is a dangerous market. You want to be very careful. Typically, we see a correlated market to the downside, but that's not always the case. When the market syncs up and correlates, we can get some extreme price moves. All right. So the VIX is kind of holding those lows, We do have a VIX hedge on from last month. But I wasn't interested in closing it down until I had another one opened. This thing was up around $250 on Friday. And I mean, obviously, we want to close it down and take our profit, but we don't want to do that unless we can open up another one, right? Because then it leaves us exposed. And what can happen, and it's happened to me, you close a VIX trade down, you close a hedge, and then you try opening another one and you can't get it opened, and then the market really starts to crash, and there you are with no hedge. So as a rule of thumb, I don't like to close, or I don't like to close a hedge until I've got another one open. Now I've got two. I got a June 15 90 strike. It is, yeah, it's okay. That'll do, but it's not a very good one. All right. Just a little bit of housekeeping from last week. We still have that JP Morgan call that we bought, the 185. So you can see we're kind of gapped up, but fading back to close the gap from this morning. We still have the other gap from where we fell down at the 167. Depending on if this turns around or not, we'll probably go in and sell a call. I'll probably sell calls through the day a couple of times. Day trading by selling calls against the call that we already own. That's a good way to day trade options. And we still have that Costco trade on. We got it rolled, by the way, and took all of the risk out of it. So right now, if the trade was to lose, we would just lose $4, but it's up $150. So that gives us a locked in profit. Going to be looking to try to roll this again today. Collect some credit on it. And that way it's just a no-lose trade. All right, let's take a look around out there. CVS is in a high squeeze. It's a 15-minute. Lockheed Martin is in a low squeeze. And there's JP Morgan. So the financials are kind of getting crunched a little bit this morning. Tesla's on the move, over 4% this morning in Tesla. So Tesla took that rejection at the 1130. That's going to be the goalpost for right now. There's a lot of trapped traders sitting in there, and they're going to be using this for a way out. You want to keep your eye on this, and what you're looking for is a measurement between a soft rejection and a hard rejection. A soft rejection would mean that we kind of fade off a little bit and then rally back at it, whereas a hard rejection would be that we get there and just take a smack down and we fall all the way back down to the low of the day or worse. We don't yet have enough candles to snap a decent Fibonacci, but we'll put on what we got. There's our 786. Now, typically we would use the 786 for the pullback measurement, kind of asking the question, is it just a pullback or is it a market rejection? So, Keith, I'm gonna be looking to close the short duration options on that VIX. I've still got the June 15 90 strikes, but I'm looking to get out of those December 22s. I should have went ahead and did it Friday, but going into the weekend, I just really wanted to hang on to those in case things did get worse. They didn't. We can see that we're kind of holding the line. The news is stabilizing. So I want to roll out of those Decembers. And since I've already got June, there's really no reason for me to actually roll those Decembers. So I'm just going to close out of them. But you can see I put a limit order in at 450. It's not going to happen quickly, right? And it may not happen at all. That limit order that I set was in case we got a spike today, because we do have some news coming in throughout the morning. If that news doesn't rock us around, then I'm going to look to close those Decembers by the end of the day, and I'll just keep my 90s on. And this isn't a really good time to open a new one. You wouldn't want to open a new one right now. I had those Junes. I already had them. I've been in them for over a market month. You wouldn't want to get into new ones right now because we're still very elevated and it's going to cost you a lot of money. If you have one on and it isn't going to expire yet, keep it. Because if you was to go and try to buy one right now, it's going to cost you so much more money. If you do look to get a new one anyways, what you want to focus on is these numbers here. Now, typically, when we're not talking about the VIX, the farther out in time, the higher the volatility. And that makes sense, right? Because farther out in time, there's just so many unknowns. But in the VIX, it's the opposite. Right now, everybody's still concerned about all these issues, supply chain, coronavirus, Evergrande. There's all these things causing fear in the market. And so we're very elevated in our implied volatility close in. If you are looking to start a new hedge, I would recommend going farther out so that you can get it cheaper. Now, if we were to go to like Apple and go 200 days out, the farther out we go, the more expensive those options would be. And that makes sense because the volatility is higher. And yet in this situation, it's the opposite to a point. They have time and that's going to bid them up, but they have lower volatility and that's going to keep that price down a little bit. That's where I would target if you must get out of the current VIX hedge that you have and you need another one. That's where I would go. And that's what I did last month, right? I went out to June of next year. And you can see, I mean, I got my June calls for 35 cents. I've got the 90 strikes, so I'm way out of the money. And, I didn't want to spend a lot of money out there, just a couple dollars. I spent $35, bought 2 of them. If they bid up a little bit more, I'll close one, and that will give me a free one, right? Because if I can get $35 profit by closing one of them, and I spent $35 each, then I'll actually be holding one for free. But we're not there yet. Or because of costs, something like the March series, maybe run an out of the money like a 30-50. This is a $20 wide hedge, so it's a $2,000 hedge for $230. You can see the max profit here, $1,700 minus our costs, right? So, I mean, it's not an open-ended hedge like a call, but it does have some profit factor in there. Depending on your account size, you may want to think about something like a back ratio. But either way, the VIX options farther out in time have a lower vol. That should offer you an opportunity to get into them cheaper than trying to run these closer in trades, right? And I'm just going to hang on to that VIX December contract until later in the day and then look to get out of it at that point. So JP Morgan turned around and is flat. Maybe swapping over to the other account and come in and day trade, selling calls against the call that I own. I've got the 185, April 14, 185 call option in JP Morgan. And that means I can sell the 185 or farther out. And as a day trade, it's not a bad way to day trade because we just sell it and then come back and buy it later on. I usually do a lot of trading like that around lunchtime. That way I can, sell a couple calls, go eat lunch, come back, buy them back. Don't really need price to move that much. And it's not like JP Morgan's going to 185 today. It's not like we'd be looking at a whole lot of risk. All right, Tesla stabilized. It's almost enough time now to where we can use the fib appropriately. But on a 5-minute chart with only 3 candles, there just wasn't enough information for the Fibonacci. But there goes Tesla breaking out of that range that had been set. We've got this orange bar from back here showing where the liquidity is at. We're looking for a soft rejection. There is a lot of trapped traders there, and they're going to take this opportunity to get out of it. The way that they would get out is that they want to sell the position that they're in. So, of course, when we come into that liquidity, they're selling because these people are just grateful to get out of the mess that they're stuck in. But what we want to monitor is, is it going to be a soft rejection or not? So far, it looks like a soft rejection that we got there and that we gently pulled back away from that level. Now, Tesla is up, 4.5%. So for me, I wouldn't be looking to go long in this at this point. But I am watching it for a chance to trade it short and run it back down to where we opened. I just don't want to go long in something that's already up 4.5%. ACN inside day breakout. So you can see that it left Friday's range and Thursdays, and of course Wednesdays, Tuesday. We're actually inside of Monday's price action right now from last week, but it's an inside day breakout. That's what we want to focus on first. This is a red to green with an inside day breakout. This setup is one of my favorites. When we go out to a daily chart, this is what you want to look for in the pre-market. Yesterday was a red day. It's an overall bullish market. We had a pullback. We had a red day. And then in the pre-market, we rallied up close to where we opened the day before. And look at the wick on the bottom of this. And if you're looking at that saying, what wick? That's my point. There isn't one. This thing opened and started running to the upside. Broke out of yesterday's price action and broke out of the range and is on the run. On a market that looks like this with this setup, 4% is the target. So if you're looking at ACN and you're thinking, oh man, it's already up 3%. Yeah, it's still got another 1% left in it, at least, right? It's got that kind of fuel. So it can do it. Just to kind of get a gauge for its average daily range, here's ACN. And we can come in and ask, what's the ADR? 1.54%. Okay, so its average daily range is 1.5%. But it's got an additional market maker move of more than 0.5%. That'll give us a 2% right there. We could move 2% and it wouldn't even be considered outsized or unnormal. We've got an expected move differential of over $11. So this thing definitely can make the move. It does help that this is a bullish market to begin with, right? This trade setup works better in a bullish market than it does as a reversal market. NVIDIA is still inside day. Looks like it's struggling for a breakout opportunity. This is also red to green, right? I said there'd be a lot of these today. So we're red to green, but what I like about NVIDIA is that we're inside day on day number 2, right? So this is the controlling candle way back here. And then on Friday, we stayed inside that. That gave us an inside day. And then today, we're still inside of it. So this is inside day number 2. Inside days are a very powerful trade opportunity, but you don't want an inside day on a really big candle like this. That's junk. It's worthless. You want to find inside days when it's something really small like this, and then you get 2, 3, 4 days in a row where it's inside day. That's where the power is. So right now, NVIDIA is inside day number 2, winding up energy. It's just building up more and more. Be careful of that dividend. That's a December 1 dividend. It's not necessarily the assignment issue that I'm referring to here. Be careful with the dividend because the company paying dividend is a company that is handing a lot of capital out. And it has to affect the stock price, right? You can't just give away truckloads of money and not expect it to affect the stock price. NVIDIA has a fast beta of 2.5 right now, which is phenomenal. Just be careful of it. If you are going to trade these options, stay away from the front series, these December 3s on the call side, because they're going to be the ones that are at risk of assignment. And the risk is very, very small. I do want to point that out. At this point in time, it's very small. But you don't even want to get, caught up in something like that. Either my ORB indicator isn't working, or every single market in the S&P 100 is showing a 15-minute inside day, and I just don't believe that. So I'm thinking that that watch list column isn't working. Bristol Myers, oh my goodness, like throwing a rock in the water. Philip Morris. PayPal's got a nice reversal. So here we go. This is either going to V bottom or dead cat bounce. So we've pulled back quite a bit. Got a very long wick here, and it's always, a little bit of a disagreement about, should we use that long wick? Should we not use the wick? Typically, I want to do things the same way every time, and I would use the wick. But, sometimes you get those really, really, really long wicks, and you're like, I don't want to use that thing. Consistency is the best that you can do, right? Just try to do the same thing the same way every time. And if you do change the rules, have a reason for it, right? I'm going to go ahead and leave it on the wick because I normally would use the wick anyways. If we're getting a reversal in PayPal, then we would want to see this give us a higher low, right? I mean, if it just V bottoms and runs back up, fine, but that's unrealistic. I would expect some kind of price action like we're getting now. A little bit of a fade back to where it looks a bit more like that. I got to get that extension off of there. That's driving me crazy. So pull back off the 618, bounce off the 786, break through, Busby, and rally. If we're reciprocating in PayPal, that's what I would expect to see. Otherwise, if we hold within this range, we're going to be looking for a micro double bottom. That would be looking to see PayPal retest that 182.5, build us up base, and then afternoon breakout possibilities from this base would exist at that point. So we got, thesis 1 and thesis 2, or alternate thesis. What if we're bearish and we just keep heading to the downside? Then the 180 is our target. So if you're buying puts, that'd be the puts I'd focus on. It's those 180 puts. We got some serious market movers to the downside today. There's not a lot of them. It's just the names that are standing out in there, like JP Morgan. That's a significant move to the downside in JP Morgan after a nice rally up. So I've got that 185 call. I was going to wait until later in the day to trade an option on that, but I'm missing my chance to kind of maybe, manage the trade a little bit. The closest series that has a 185 even worth selling, and man, the bid ask is horrible in there, is the December 31st. And I don't want to trade the December 31st. So I'm going to go to January 21, show you guys what I'm looking at. JP Morgan, January 21. The 185 is selling around 96 cents. Wow, that dropped in value fast. We must have started the rally. So in a situation like this, we sell it, buy it back, sell it, buy it back, and we're just looking to take some of that risk off from the long call that we're holding. We wouldn't keep this trade. We're not trying to like keep a calendar or anything like that. We're not really seeing much threat either because JP Morgan's at 160 and we're selling a 185 call. So as long as JP Morgan stays underneath 185, we're not going to see any kind of risk. And all we're looking to do is just kind of hold this for, a couple hours, maybe a day or two, and then buy it back cheaper. All of the financials are getting lit up. So let's go take a look at the financials. I like to use XLF. KRE is another way you can go. It's just different sector names. So here's the XLF. You can see that nice sell-off after the bell. Nothing's really turning around. BlackRock is holding the range from an inside day gap out play. That was a red to green. Very beautiful. But other than that one, the rest of these look like trash. CME also is holding its range, but that's about all we could say about it. So not looking too hot, right? That's better. All right, so none of these financials are looking good. If we're going to see a reversal in the market today, it's going to have to be solely carried out with technology and energy. And energy's been so tightly correlated to finance that I just can't see that happening. So we're going to need finance to get off the bench and get into the game. We have to. Otherwise, we're not going to see that rally in the S&P. We could see it in the Nasdaq because the Nasdaq doesn't have any of these financials in it. The Nasdaq 100 doesn't have financials. So let's see what other sectors are moving around. Maybe we can get a focus in another direction. IBB is another sector that we can focus on. All right, Amgen, Moderna, Gilead Sciences, Illumina, Regen or Regeneron, Vertex, and Biogen. So Biogen isn't looking that hot, just gave us a new low. VTRX is breaking out of that 5-minute open range. There's a trade opportunity. 5-minute open range breakout on VTRX. Target is 190. That'd be Friday's inside day, or the high of Friday. Regen is sitting inside of its 5, so it has not yet broken out. That'd be an opportunity for our breakout play. Illumina just doesn't look liquid enough. Gilead Sciences, inside day breakout, 5-minute open range breakout combo. And Moderna weak to the downside, Amgen flat. So Gilead and VTRX. Gilead's actually in a better position if it can break that and hold above yesterday's range. Vertex is still sitting inside of yesterday's range, so that's the only negative to it. And that's not much of a negative, all things considered. Let's make this a little bit bigger. We can see it better. So there's our 5-minute open range from yesterday. That was the highest point as well, right? So you can see how we're not yet outside of yesterday's price action. But for today's inside day, we've got that 5-minute open range, and there's our 5-minute open range breakout. Yeah, you like it. So VTRX is looking pretty good. The other one, Gilead Sciences, look at these higher lows, higher lows, higher lows, equal highs, and we're looking for this to break out above yesterday's price and hold it. We're breaking out of that price range right now, but we don't know if we're going to hold it, and we're still sitting inside of this one shadow candle back here. We're definitely wedged up, and one thing that we can say for a fact, it won't stay here. We don't know where exactly it's going to go, but it won't stay here. We bring that out to the higher time frame charts, kind of get a little better of a perspective. Look at that blue cloud, and you can see how we bounced on the 5 back here, kind of broke through it, but we did bounce and hold, bounce and hold. You know, it's been providing a reasonably decent support, but this resistance has been significant. So we're still looking for, you know, a real breakout of this level. We don't want to get caught in another one of these teasers, right? So here's a 2-hour, kind of puts it under some perspective. These big wicks across the top, all of that rejection. Let's see. We need a way to quantify this. Let's just start with an RSI. A pull back to the 50 and a run back up. Okay, get that. In the MACD, maybe look for a little bit of divergence, right? So on the RSI, this is where we set a high, and then it faded off from there. So we got divergence in price action, and the same thing with the MACD. I don't know. I guess the MACD isn't that bad. But we did start getting that rally here, and that's where the MACD went sideways instead of rallying up with it. So a little divergence in the MACD, a lot of divergence in the RSI. You know, sometimes that bot just does not grab what we think it's going to grab. That was not what I was trying to share. Sorry about that. All right, so we got this little micro cup and handle. And with Thinkorswim's new quant tool, you can see how we're measuring that cup. And the way that you project the next move up is you measure the depth of the cup. Well, this new tool does that for you. So the 200% that you see up here is that depth plotted up there. Which puts Gilead Sciences right back up around that $78 mark. But there's a lot of resistance to get there, mainly right around the $73 mark. So if we can get above that, it's game on. For the current situation, we've got an inside day breakout, and we've got a serious resistance level at this pivot point back here, 7103. We get through that, and we'll be looking at 7165. Let's try to help this guy who's asking about a dead cat bounce. You need a daily chart, a significant fall, and a pullback. Simple, right? All right, that island reversal on the communications sector was something that I was looking at over the weekend. Now, this could still fix itself since the failure was kind of connected to the news about that new variant. But you can see that the failure started before that news. So I don't think it's going to fix itself. So this is a failed bullish island reversal. Oh, great example, Beth. That's awesome. Big pimp. We still have a really nice flag in XLY. Notice my note here. XLY has Tesla influence. You can see that we had this really solid range. And then we broke out of that range with conviction, and we're now setting up a new range in this flag up here. And the flag is still intact even after all of that news that came out. So this pattern is still in play. Nice red to green also. This is a perfect example of a red to green. It's exactly what we want. We have a trending market, right? Kind of put all the pieces together. We had a market in an uptrend. We pulled back and had a red day that closed in the lower part of that red day. And then in the pre-market today, we opened higher than we opened yesterday, and we almost opened higher than the entire day of yesterday. We faded back and found support at the open, which is an institutional pivot point, and then we rallied back up and out. Now it's struggling, right? We can see that it's struggling, but it's still up more than 1.5%. Dan giving a shout out on Alibaba. You can see that this thing broke a significant low. Now, there's something to be said about this, right? Now, IBD is the one that really got me on this. I used to think that a double bottom was supposed to be the same stopping point as the other bottom, right? So this was our low back here. And the way that I thought these double bottoms were supposed to be done was that we come down and we test that pivot from the previous low and we bounce. We do that a lot, but a really good double bottom is supposed to go lower. You actually want it to go lower. Now, when I would see that it would break lower, I used to think, oh man, shoot, I guess I don't want it now. It went lower, and I would kind of dismiss it and I would go look for something else. But what IBD pointed out is it's a good thing if it breaks lower than the previous low. It's designed to do that. It's supposed to do that. John Dalton added to that and said, if it bounces exactly where it should, exactly where you think it should, it's probably retail traders that are trading it. And remember, we don't want to follow retail traders, right? We want to follow the institutions. If it's a perfect bounce, you're following the retailers. If it breaks lower first and then rallies out, you're following the institutions because they're going to break it lower to shake out the weak hands, right? All the guys that are running a really tight stop and they get scared and they're just paper hands, they're getting shook out at this point, right? So when you put the two perspectives together from Dalton and then from IBD, you can kind of distinguish the difference between, was that our retail traders play or was it the institutions play? Now, Alibaba took that rejection on the 5 today and had a beautiful fall. So right now we're sitting in this flag pattern. We do have enough time that we can snap a fib. You can see that we're getting a failed flag setup. I love that setup. The way that I quantify a failed flag is I snap the Fibonacci and I'm looking for price to come out of that 786-100 base and then Busby and reciprocate back up to those highs. Now this is more V bottom than flag because it just set a low and ran right back up. I would have liked it more if it had based down here first. Maybe you retested that 100 line at least once and then rallied out. The target in BABA is at least the 135, or excuse me, the 134, and 135 would be better. Just keep in mind this really big orange cloud here, that's the 510 daily moving average. And also just gave a shout out on Oracle. You can see that we're inside the cloud of the 510 and we're also inside of yesterday's price action, but we're looking to break out of yesterday's price. So this would be an inside day breakout in Oracle. Nice rally up. It is up more than 1.8%, but you know, a little bit of perspective. It has the juice to keep going. For Oracle, you do have a little bit of resistance around 94.5, and the target would be 95.5. I would use Friday's options at least, maybe even go 2 Fridays out, and I would buy the 95 or the 96 calls. Now that's a little bit of news. All right, what else we got? Metals and mining are getting kicked in the face, breaking to new lows even while I talk with that Marbozu candle. China giving us a nice flag pattern. It's a failed flag. Well, I mean, it hasn't failed yet, but it's lining up to be a failed flag. Airlines are still squishy, still showing us a flag. Oh, man, industrials. Oh, my goodness. Oh, wow. Okay. Well, I don't know. Those things are really rocking and rolling. The industrial sector is on the move. Look at how fast it's going, outrunning that 10-period daily moving average. Let's go in here and take a look around because this thing isn't overly expensive, which means it's a great product to maybe build a little bit of a hedge. We're going to replace the gamma with delta. And let's see, we want to maybe buy the 44, sell the 98, and buy the 97. Uh-oh, I think I broke my thinkorswim. Nope, it's okay. All right, that was not the trade I was looking for. That's the trade I'm looking for. I don't want to pay a debit for it though. So we're going to want to adjust it just a little bit more. But notice how we have a very limited amount of risk to the upside. $63. And it has an unlimited downside. So let's just try to move it around a little bit. That didn't help. I think it would be easier if we do it on Tastyworks. All right, so we're looking to sell the 102, buy 3 of the 97s, and then sell a 95, and then we throw it into the analyzer, and we take a look at it. $35 a risk to the upside. That's not bad. I would still like to see that better. Plus, our valley is a long way down. So we kind of want to move things to the right a little bit. We're trying to put the valley of this thing closer to the current price. This trade right now is set as a credit. So if the market rebounds and rallies to the upside, we just make $72, meaning we don't lose. If the market falls and dumps to the downside, it's got unlimited profit opportunity. So this makes it a hedge. The reason it's a hedge, if you think about what happened during coronavirus, right? In that February and March, everything crashed, everything fell. Now, this trade would make money from the fall, but it makes more money from the volatility spike. And during the corona crash, that volatility spike jacked the options up across the board in everything. Every single thing out there had an IV just pinned out at 100. Now, this trade does have a risk. If XLI was to just stay right there in the middle and not do anything, that's where your risk is going to come in. But there's a few things that we can do for that. One, you wouldn't take max loss unless you just held it all the way to the close blindly without doing anything. Who would do that? And then second of all, we can adjust it, we can roll it, we can do something, and we can also put a butterfly right there. Butterflies are really cheap. You know, you could spend $10 a week and just buy a butterfly and stick it right there in the middle so that if price doesn't move, your $10 butterfly is making you $100 at a shot. So I kind of like this one. We're probably going to have to work the order a little bit. These don't fill very, very quickly. And I'm going to bump the price back up into the 60s. Actually, I'm going to go to 75. Okay, so I got that order. It's in the queue. It's working. There's a lot of strikes. So even if I was willing to take the credit that they're offering, that $58, I still probably wouldn't get filled very quickly. It's not my broker. It's just the fact that there's so many strikes, and it's trying to catch the mid between all of those, right? 3 legs, 5 options. That's a lot of bid ask. That's a lot of spread, right? So, when you're working an order like this, be prepared to actually have to work it. That it may take a little while, and it's okay, right? We don't want to just blindly take whatever credit they offer. And if we were buying this, we wouldn't want to just pay whatever they say to pay, right? You wouldn't do that at the flea market. I hope you wouldn't do it at the flea market. So let's talk financials since they're getting kicked in the face. All right, we got a rising wedge, and we know how those end eventually, but they could go on for a long time. We're on a monthly chart, bullish trend, positive CCI, price above the 8. We got a rising ADX. We got a rising MACD, upside momentum, but it's a monthly chart, right? So we want to step that down a little bit, bring it into the weekly. We've got a MACD slope kind of heading to the downside. The histogram is getting smaller. On the weekly chart, a negative CCI with no trend, price below the 8, a declining ADX, and possible pullback conditions. Now, I will point out that not last week, the week before last was a MDP. It's a missed daily pivot. This right here. And when you get a missed daily pivot, that's a bullish signal. And after you get that bullish signal, you very often pull back and test the S1. Right now, this is kind of pivot point logic. Let's bring it into a smaller time frame so it makes sense. So on a daily chart, if you were to bring up an indicator called person's pivots, person's pivots will automatically tell you its measured direction. I don't like the dots. That's not going to help you guys out. Let's take it to a different time frame. I guess we'll use SVE then. Yeah, that'll work. All right. So SVE pivots. Now each one of these days, it's just such an ugly mess. Surely we can do better than that. That's just confusing. Okay. So a missed daily pivot is when you get a bullish price move and price does not touch the pivot through the whole day. Price generally touches a pivot more than 80% of the time. Price will touch its daily pivot. So the fact that it doesn't touch the pivot is the first significant piece of information. The next day, what we often see is a test of the S1. That's your entry. Now, it's called missed daily pivots for a reason. It's normally something that we would quantify and measure using daily pivots. But when we were out there on the weekly, that same situation is going on here. On that week, we did not hit that pivot. And in this week, or, the holiday week of last week, we pulled back to an S1 position. That would be our bull entry to run that thing back up. That's how the missed daily pivot setup works. So the purple line is the pivot, right? And what we'd be looking for, it actually hit here, but we'd be looking for a breakout of a major range. So we get a breakout, it stays bullish, it doesn't touch the pivot that day. The next day, it pulls back, tags the 7/8 or the S1, and then continues that move. The strategy is called missed daily pivot, but you can run it on any time frame. Every one of those pivots have strategies connected to it. Camarilla pivots, Persons pivots, the SVE, all of them. The person who created them has books written on them. There's videos done. If you're just using regular floor pivots, you could run something like first test. Now, first test kind of reflects what I was talking about in my morning briefing when we were talking about the ES market, where I had pointed out that it was very likely we were going to run up and bounce against that orange line or that orange bar, and that we would get a little bit of a pullback. And even if the pullback was just going to be a soft pullback, not a hard pullback, not a hard rejection, it would be a tradable opportunity because it would be first test. First test is great for scalpers and small momentum play, or not momentum, but just small scalps, right? You take a very large position for a very small price move. Tastyworks is a great broker for that because in options on Tastyworks, after your first 10 contracts, there is no commissions on the rest for that trade. So instead of buying 10 calls, I could buy 50 calls. The commission stops at 10 calls. That makes it a wonderful broker to put on trades where you want to trade a lot of size for a small move. 20 or 30 calls, and you see something like, a 5-cent gain or a 10-cent gain in that option, and you start pyramiding out of the position, your day done. Just like that. So first test is a good trade strategy. For Camarilla, it's a completely different system, though, and it's already built in. Wow. Twitter halted, huh? I guess the guy ain't leaving after all. Dan is on top of it, guys. Check it out. I still want to know, like, why was the market so happy that the dude was leaving? And why are they so upset now that he's not leaving? Because without that information, we really don't know what to do with it, right? And I haven't had a chance to check the news because I've been streaming since it's been happening, and I haven't gone over and looked. Oh boy, I'm telling you, things are really picking up out there. So this move in the bonds is being reflected across the board. Stocks are down, bonds are up, right? Stocks and bonds, stocks and bonds. So stocks are getting kicked in the face. Bonds are making a nice rally to the upside, trend line breakover, coming back up into its own price action. The dollar really isn't doing anything. That's kind of a reflection of uh, volatility at the moment. And that's something I want to point out. You see this move down in the Russell, and you see the move down in the Dow. We're not seeing that reflected in the S&P or the Nasdaq, and the VIX is not confirming that fear, right? So it's only based on some impact to the Dow and to the Russell. If it was across the board, we would see the VIX rise, and it's not. So now we can kind of go in and ask, well, what's doing this? Is it a particular sector or industry? We can go to Market Watch, and we can go over to the Dow and just kind of ask that question. I'd start with the Dow because the Russell's got thousands of names. Merrick. So Merrick's really getting whacked to the downside. But look at these other names: American Express, Boeing, Caterpillar, Disney, Goldman Sachs, Travelers, Visa, Verizon, Walgreens, and Walmart, all getting smacked to the downside. And even Honeywell is a little soft, right? 15 names in the Dow. So 50% of the Dow is negative today. And the money flow is bullish, but not by very much. Now we go over to the S&P 100. Look at the bleeding in here. And yet that market is still running sideways. %52 of the S&P is moving up. The money flow is still 7-1. And yet we're maintaining that sideways run. Why? Because the futures can become disconnected from the basket of stocks that it represents. And that will be when the institutions deliberately go in and trade against the futures themselves rather than the algorithms trading the basket. Okay, when we started, the EEM was up 1%, and now it's down to 0.25%. Beth just gave a shout out on some really big news for AMD. Tesla is going to start using AMD chips in their Model Y car in China. This could be a significant game changer for AMD. It was already a bullish company. You can see here on the monthly chart, it's starting to go parabolic. If we bring it into the weekly, we can see that we're at inside week. We've got a lot of bullish momentum and bullish flow. Bring it into the daily. You can see how we've been getting those equal highs and higher lows starting to form a wedge. And now it's very likely that we're going to break out of this wedge. So far, it's not as aggressive as I would have expected it to be yet. But it is very likely that Beth pointed out news that has not yet really spread out to other places, right? You know what I mean? Like, she could have gotten it so quick that nobody else has really gotten caught into it yet. Because she's just that fast. So I was really hoping to see a cleaned up market today. And I was going to come in this afternoon and build the watch list for tomorrow. And I may still do that, but we've got a lot of uncertainty here being shown in a lot of these sectors. And without the guidance of that, we don't have a lot to lean on. That doesn't mean we can't find some trade ideas, though. So be on the lookout this afternoon. I want to come in and build tomorrow's watch list, probably a couple of momentum and trend lists, short duration swing trades, and tomorrow's day trades. And I'm going to be doing that in the trade systems chat. This is where I will post the stream link. And when the video is done, because I'll be recording it, you'll be able to find the stream replays here. In the trades that we take, I will be posting those here as well. And you can see the other trades that we did before the holidays and before I went on vacation. I closed most of the USO, but I did keep one position open, but that turned out really good too. And then, of course, the day trade that we took for Facebook. So I'm going to be looking to do one of those videos later in the day. Probably around 3 o'clock, 2 o'clock, something like that. I'll keep you guys posted. I would much rather have like a longer term swing trade, but we just don't have the setups right now, right? So we're going to be focused more on short durations swing trades and some day trades for tomorrow. Not sure who you're talking to, Don. So we got this really tight range here in SPY. And we are coming into lunch. So what we're going to be looking for here is, will SPY hold this Globex low and maintain its range for the day, or will it break that low and give back the 0.75% that it gained in the last 15 hours, right? Because when Globex opened up at 6 o'clock last night in the futures, SPY, which is a 24-hour a day product, came back online and had that massive gap up from the Globex open. So it's been keeping that all night into the morning and now into the trading day. If we give it back, if we break that low, the target will be Friday's close. So that's the puts I'll be buying, 457 puts. Now, I'm not interested in shorting the indexes just for GP, but, we're talking about puts that are probably $2 or $3. Hey, I don't like to lose, but $2 or $3, I don't care. I'm not going to stay awake at night tripping over a couple dollars. Now, here's the pickle. 457 is not $5 calls and $5 puts, right? That's $160. That's a game changer. I don't want to just go spend $160 hoping we're going to fall. Hope is real, but hope is not a good trade strategy. Now, we can go far out of the money, maybe really far out of the money. But you can see, because of the volatility skew, here we are at a 5 delta, and we're still looking at $50 puts. So, for some put lottery plays, a lottery ticket is supposed to be, $5 lottery tickets, not $50 lottery tickets. I don't want to throw a $50 lottery ticket out there. So I'm not going to use SPY. We'll use something else. All right, well, those bonds are still moving. The dollar is still in that range, but we got that tweezer top. Just keep our eye on the dollar as we come out of lunch. Don't forget, we've got an additional auction today at 11:30. That can be the game changer. We don't want to see this VIX continuing to be bid up. So we want to see that VIX kind of hold its intraday high and not give us a new high. But that tweezer bottom makes me a little bit concerned. So we've got our boundaries set in the VIX. We've got our boundaries set in the dollar. Keep your eye on that bond. It's the bonds right now that is moving our market, right? When we talk about it all the time, what's moving the markets? Why are we going up? Why are we going down? Well, right now it's the bonds. Now, IBD and the TD Ameritrade network were both, and Bloomberg, were all talking about the institutions had started to price in a rate hike for the later part of 2022. And then the corona news hit. And on Friday, they began unwinding that position that they were building into, that they were pricing in. It looks like they're not done yet, but they're doing it in a more controlled way now than they were Friday. Friday, it seemed like close to panic. And now it's a lot calmer. They are liquidating. We are in a risk off situation. They are fading out, but they're doing it gently. Give me just a moment here, guys. I am going to finish off the restream, and so I'm going to be muted for a moment. All right, everybody over there at the well, I guess I can't do it that way, huh? I guess I can't do it that way. Well, anyways, I'm going to kill the restream. So everybody who's watching live on YouTube, appreciate you watching. But I'm going to end the stream now and just stream for the community itself. If you liked what you saw, come join us. Sign up for your trial. Hop into the Discord. Ask questions. Participate. And I will see you guys tomorrow.